The whispers just got loud. Indicators are flashing across the dash, and the soft landing script is slipping out of frame. The only questions left are when the recession hits and how deep it cuts. For homeowners, that timing is personal. It's mortgages under strain, equity on the edge, and comps rewritten overnight. Some markets sit on bedrock. Others balance on fault lines, where a single shock can turn price cuts into negative equity and forced sales. A downturn doesn't nibble. It snaps confidence, tightens credit, and reprices inflated homes in real time. The boomtowns built on speculative inflows, investor churn, and rate-sensitive jobs are first in line when the floor tilts. So which former darlings are now the most exposed? Where are days on market stretching, inventory stacking, and builder incentives creeping back, the telltale cracks before the break? We pulled the data and mapped the stress lines. Up next, the 10 most vulnerable housing markets if a recession lands. And yes, number 1 will shock you. Number 10, Dallas, Texas. Dallas looked unstoppable. Relentless corporate relocations, high-pay jobs, and a pandemic-era surge that sent prices far beyond local incomes. But the same engines that powered the boom, rate-sensitive demand, investor activity, and aggressive building, are now the city's pressure points if growth slips. The tape has flipped. Inventory across DFW has soared to multi-year highs, with active listings reaching roughly 32,000 this summer, about 60% above the long-run July average since 2017, while months of supply has climbed toward balance. Price cuts and under-ask closings are spreading as days on market stretch. Builders leaned hard into the northern arc, and that pipeline needs steady relocations to clear. If a recession halts expansions and tightens credit, absorption slows, concessions deepen, and comps reset faster in supply-heavy ZIP codes. Single-family months inventory moved from roughly 3.5 to 4.7, and active listings jumped more than 35% year over year. Investor behavior is the wild card. DFW saw meaningful investor participation through the boom. If rents soften or refis stall, those buyers can flip to forced sellers, amplifying inventory and accelerating repricing, especially in homogeneous subdivisions and new build corridors. Bottom line, Dallas's scale and diversified economy help but don't eliminate downside. Rapid appreciation, swelling inventory, and reliance on continued inflows create real fault lines. In a recession, late-cycle buyers in the supply-rich suburbs face the sharpest equity risk. Number 9, Denver, Colorado. Renowned for its mountain vistas, outdoor-first lifestyle, and surging tech scene, the mile-high city became a magnet for remote workers and young professionals, fuel that sent prices skyward and affordability to the edge. Inventory is swelling, days on market are stretching, and leverage is shifting back to buyers. Listings are piling up and going stale. More than a third of Denver homes sat 60-plus days without an offer this spring, a function of rising supply and buyers balking at payment shock. Statewide and metro inventory hit decade-plus highs, with months' supply near 4.4 to 4.7, levels not seen since 2013. Affordability is the stress point. With rates hovering in the 6 to 7% band, demand won't clear excess supply quickly, and sellers are leaning on concessions to move deals. Denver even led major markets in June price cuts, a clear sign that list prices are being dragged to reality. In a recession scenario, pressure amplifies. Tech freezes and tighter credit reduce relocations and thin the buyer pool, while condo HOA costs and insurance weigh on carry. Expect longer marketing times, deeper discounts, and faster repricing in supply-heavy corridors if the economy slips. Number 8, Tampa, Florida. Sun-drenched Gulf Coast glam, Pulled in migrants, investors, and cranes, Tampa became a boom emblem where beaches, lifestyle, and easy flights sold the story. In a recession, those same pillars turn fragile. Tourism slows, relocations cool, and buyer confidence cracks. Inventory built up through the boom meets 6 to 7% mortgages and an insurance bill that already strains budgets. When discretionary spending drops, hospitality and services take the first hit. Job losses thin demand, listings linger, and sellers chase the market down with cuts and concessions. Florida's property insurance squeeze is the accelerant. Premiums that add thousands per year are manageable in expansion, punishing in contraction. Stretched owners become forced sellers, especially across investor-heavy condos and short-term rental pockets. Builders poured concrete at speed. If in-migration chills and capital tightens, that pipeline turns into oversupply. Vacancies rise, rent growth stalls, and cap rate math resets. The first repricing tends to appear in homogeneous subdivisions and newer condo stock where comps move quickly. Bottom line, Tampa's boom was real, but rate sensitivity, discretionary-driven jobs, rising carry costs, and a large new build base leave clear fault lines. In a downturn, a broad 15 to 20% price giveback is plausible in the most supply-heavy and insurance-exposed ZEED IPS, putting peak-era equity at risk for late entrants. Number 7. San Francisco, California. The global emblem of tech wealth and scarcity pricing has long bent the rules, but gravity returns when the cycle turns. In a recession, San Francisco's housing market is uniquely exposed. A heavy tech dependency, extreme unaffordability, and persistent outmigration leave thin margin for error even as AI-driven green shoots keep select segments afloat. Under the hood, signals diverge. Bay Area sales cooled in 2025 versus 2024. Yet San Francisco sales ticked higher on an AI halo and returning office demand. At the same time, condo resale risk rose, with more than a third at risk of selling at a loss in Redfin data cited by local reports. Prices stabilized year over year, near the low $1.2 million to $1.4 million range, but forward forecasts flag downside over the next 6 to 12 months as inventory climbs. If a recession lands, the sequence is brutal. Tech layoffs widen, equity comp shrinks, and high DTI buyers vanish. That hits SF's core demand directly, stretches days on market, and forces comps lower, first in investor-heavy condos and luxury tiers tied to stock wealth, then across move-up segments. Broader projections show Bay Area values drifting down through 2025 to 2026 under affordability and rate pressure. Investor behavior magnifies moves. Pullbacks or liquidations in a risk-off tape add supply into a market with thin affordability, while elevated HOA/insurance and tighter underwriting weigh on condos. Even with improving multifamily fundamentals, vacancies falling, rents edging higher, for sale inventory spikes and slower sales can still drag prices if confidence breaks. Bottom line, SF's crown, limited land, huge incomes, global cachet, doesn't immunize it. With tech cyclicality, stretched affordability, and ongoing outflows, a recession could force a sharp repricing, especially 20 to 25% in the most equity-sensitive, investor-dense pockets. The city that defined the boom is one shock away from a hard test. Number 6. Seattle, Washington. Rain-kissed and tech-powered, Seattle's housing boom rode Amazon, Microsoft, and a steady influx of high-earning pros, pushing prices skyward and anchoring affordability to stock-linked salaries. But a recession would flip those tailwinds. Tech freezes thin the buyer pool, confidence slips, and elevated payments at 6 to 7% rates force sellers into cuts and concessions. The market is already loosening. Active listings are up roughly 25 to 30% year over year across the metro. Months of supply has climbed toward 2.6 to 2.8, and the share of fast-pending listings has fallen sharply since spring. Clear signs of balance emerging after years of scarcity. Prices are still up modestly year over year, but the pace is cooler and more selective. In a recession playbook, Seattle's concentration risk bites first. Layoffs or hiring pauses in tech reduce relocations, shrink equity comp-fueled demand, and stretch days on market, with the fastest repricing in condo corridors and rate-sensitive move-up tiers. Inventory doesn't need to spike to drive a correction. At today's affordability, a steady 2.5 to 3.5 months can reset comps as sellers chase bids. Bottom line, built on seemingly endless tech growth, Seattle is vulnerable to a macro slowdown. With inventory trending higher, market intensity dropping, and payments elevated, a 15 to 20% giveback is plausible in a recession, especially in supply-heavier or condo-dense zip codes where comps move quickly. Number 5. Boise, Idaho. Tucked into the Treasure Valley, Boise became the poster child of the pandemic boom. Remote workers chased space and value. Builders blanketed the fringes with new subdivisions, and prices ripped far beyond local incomes. That external demand engine is now Boise's risk. If a recession hits and remote work inflows fade, the buyer pool thins fast while a big new home pipeline still needs absorbing. Supply is already climbing. Ada and Canyon counties are hovering near 2.8 to 2.9 months of inventory, up notably from 2023 to 2024. While market trackers show inventory rising 12 to 30% year over year into summer 2025. Prices are flatter and more selective, with list-to-close ratios near parity only for well-priced homes. The vulnerability isn't just volume, it's composition. Boise's surge leaned heavily on in-migration from pricier West Coast metros. That demand is rate-sensitive and job-dependent. With mortgage rates in the 6 to 7% band and new construction still active but increasingly incentive-driven, any macro shock can turn more choice into excess supply and faster comp resets, especially in homogeneous subdivisions. Local reads show stability on the surface. Median prices up low, single digits year over year, days on market in the teens to 30s. But the balance is fragile. If tech hiring slows and relocations stall, months of supply drifting from approximately 3 toward 4 to 5 would be enough to pressure values, first via concessions and cuts on new builds, then via resale repricing. Bottom line, Boise's boom was built on external demand and new construction. In a recession scenario that dents migration and credit, the math flips, inventory stacks, absorption slows, and late-cycle equity gets tested hardest in the newest tracks and fastest-growing ZIPS. Number 4. Miami, Florida. This glittering, iconic global city, a magnet for luxury tourism, international investment, and vibrant culture, experienced an unparalleled housing boom in recent years. Its radiant sunshine seemed to promise immunity from economic woes. But if the U.S. economy enters a recession, Miami's housing market could face a severe and painful collapse, with values potentially falling by 18 to 22% as its core drivers falter, signaling a market crash. Miami's explosive growth was fueled by its booming tourism and hospitality sectors, a continuous influx of international capital seeking a safe haven and an appealing lifestyle. Builders responded by pouring concrete for luxury condos and high-end homes at a furious pace. However, a national recession would directly impact these pillars. Discretionary spending cuts would hit the tourism industry, leading to widespread job losses in hospitality. International investment, often sensitive to global economic uncertainty, could rapidly retreat from the real estate market. The danger for Miami is compounded by Florida's escalating and crippling property insurance crisis, which already adds thousands to homeownership costs. In a recession, this burden would become unbearable for many. The sheer volume of new luxury inventory built during the housing bubble would sit empty as demand for high-end second homes or investment properties plummets. Mortgage rates at 7% would make luxury purchases untenable for most buyers. Miami's housing market, built on a foundation of tourism and external investment, is highly sensitive to cuts in discretionary spending and global capital flows. A recession would expose its speculative excesses, triggering widespread home price corrections and significant equity losses. Number 3. Las Vegas, Nevada. A desert boomtown built on conventions, casinos, and spectacle, Las Vegas rode a powerful post-pandemic wave of tourism, in-migration, and investor capital that sent home prices and building activity surging. That same engine makes it volatile. When discretionary travel slows, rooms go empty, gaming drops, and service payrolls get cut, pressure that moves quickly from the Strip to paychecks to housing demand. Early signals already show a cooler tape. Inventory is higher, days on market longer, and price reductions more common as buyers push back against elevated payments and tighter underwriting. In a recession scenario, the sequence is harsh and fast-moving. Tourism and conventions retrench, job losses rise in hospitality and services, and distressed listings increase, especially where owners were banking on short-term rental cash flow to cover carry. Investor concentration amplifies the cycle. If visitor counts slide and STR yields compress, investors tend to flip from bid to ask, adding supply and forcing comps down across homogeneous subdivisions and condo corridors. Builders ramped aggressively into demand. Should in-migration cool and credit tighten, that pipeline becomes excess inventory, driving deeper concessions and sharper base price cuts to clear standing spec. Bottom line, a market powered by discretionary spending and speculative flows can give back fast. In a downturn, Las Vegas is among the most exposed to 25 to 30% drawdowns in the most investor-dense, supply-heavy zip codes, putting late-cycle equity at acute risk. Number 2. Phoenix, Arizona. Once the archetype of the post-pandemic boom, sun, space, and investor capital, Phoenix drew remote workers and flippers while builders paved the valley with new subdivisions. That momentum now cuts both ways. Higher rates, a swelling active listing count, and cooling demand are shifting the market toward buyers before any macro shock lands. Inventory has climbed sharply. Local trackers cite active listings up 40 to 54% year over year into mid-2025, with roughly 24 to 27,000 homes on the market, highest July levels in a decade, and days on market stretching into the 50s. Price cuts are more common, builder incentives are richer, and sale-to-list ratios have eased to about 98%. If a recession hits, the sequence accelerates. Relocations slow, out-of-state investors pull back or liquidate, and credit tightens, turning today's balance into excess supply. CoStar/Cromford reads show pending and under contract volume slipping as inventory stacks, a setup where comps reset fastest in homogeneous subdivisions and condo corridors. Builder pipelines amplify the move. As absorption softens, base price cuts and concessions deepen to clear standing spec, dragging nearby resale comps lower. With affordability constrained near 6 to 7% rates and renting cheaper than buying in many cases, demand won't mop up surplus quickly. Add perception risk. Long-term water supply headlines tend to resurface when the economy weakens, making buyers choosier and lenders stricter, another headwind for clearance in fringe tracts. Net. A 25 to 30% giveback is plausible in the most supply-heavy, investor-dense ZEED IPS if a downturn lands, putting peak-era equity squarely in the crosshairs. Number 1. Austin, Texas. Silicon Hills turned supernova, a tech-tilting boom, pandemic-era in-migration, and a construction surge pushed Austin from hot to white-hot, now leaving fault lines that are visible before any true macro shock hits. Inventory has ballooned and leverage flipped. Local and national trackers show active listings climbing sharply through 2025. Months of supply rising toward balance, price cuts spreading, and builder incentives thickening. Classic late-cycle signals in a market that depended on relentless inflows to clear new supply. The build pipeline is the swing risk. From downtown condo towers to master-planned sprawl, aggressive starts during the boom now translate into a sizable delivery schedule, absorption that needs relocations, and easy credit to keep pace. In a slowdown, base price cuts on spec homes pull nearby resale comps down fast. Demand is more fragile than it looks. A recession playbook means hiring freezes or layoffs at large tech employers, tighter credit, and fewer relocations, thinning the buyer pool while rate-locked owners list only when forced, extending days on market and widening the gap between list and close. Investor behavior amplifies moves. Austin attracted significant investor capital during the run-up. If rents soften in supply-heavy corridors and financing stays tight, those buyers can flip from bid to ask, stacking inventory and accelerating repricing in homogeneous subdivisions and condo corridors. Carrying costs add pressure. Elevated property taxes and higher insurance premia raise monthly payments, just as affordability is stretched by mid-6 to 7% mortgage rates, limiting absorption even when sellers cut, and increasing the odds of distress in the most leveraged cohorts. Bottom line, Austin's boom was real: jobs, migration, brand, but so is cyclicality. With swollen active listings, a big new home pipeline, investor exposure, and payment shock, a recession could turn today's cooling into a sharper equity reset, making Austin the cycle's cautionary tale. Final message: the coming recession, whenever it arrives, won't hit all housing markets equally. But for Dallas, Tampa, Denver, Seattle, San Francisco, Miami, Boise, Las Vegas, Phoenix, and Austin, the warning signs are flashing red. These cities, the stars of America's housing boom, are now the most vulnerable to collapse. If you own in these markets, be cautious. If you're thinking of buying, prepare for turbulence. And if you want to stay ahead of the crash, make sure you're subscribed to Invest USA channel for the latest data and updates.